Hello, everybody. My name is Bruce Montgomery, and this is my colleague, Tracy Priest.
Hello, everybody.
And we're with the Road to Retail. At the Road to Retail, we try to help small, emerging challenger brands figure out how to move their businesses forward. This is everything from determining if you're really ready to grow beyond the local retail place or farmer's market, how to get started. Do you have confidence in your supply chain? Do you prove your business online first? How do you secure with a national retailer? Tracy and I have a lot of experience in this business. We've made a ton of mistakes, and if we can help you avoid some of them and move your business along faster, that'd be great. Tracy?
Yeah, so Bruce and I have been in commercial operations for over 30 years, working in things like product development, managing a broker, managing distributors, sales, marketing, trade marketing. So we have a vast amount of experience over our career. And that's why we started Road to Retail, is to share that with you. So really our intent, as Bruce said, is to lend some of our experience to you, some of our insights, and really to share with you some of the mistakes that we've made so that you don't make those. In addition to sharing some of that information with you, we also have been inviting our esteemed colleagues, friends, and associates in the industry to join us on our podcast. And we've been doing some interviews lately. And today I think we have a fabulous one. So Bruce, tell our audience today, who do we have with us?
Thanks, Tracy. Today we have Minor Hinson from Board Partners Strategic Capital joining us. Minor's the Chief Investment Officer at Board Partners Strategic Capital. And in the spirit of full disclosure, I do work with Minor and his team on their consumer health and wellness initiative. So Minor, welcome to the show, and tell us a little bit more about yourself, please.
Yeah, Bruce, Tracy, great to be on here. Thank you for having me. I really appreciate it. And, Bourne Partners Strategic Capital is a part of a company called Bourne Partners. We have two businesses. One is an investment bank, and the other is a private equity investment business. And I run the private equity business here at Bourne, and we focus exclusively in three segments: consumer health and wellness, late stage pharma, and pharma services. We've been in business for about 20 years. I've been with the firm, 11, 12 years or so. We have 20 or so people dedicated to those three sectors. And I think, we're very good at what we do, and really enjoy the job. And especially working with people like Bruce and Tracy, I think is like one of the highlights of what we do at Bourne. So guys, thanks a lot for having me on here.
Great. So Minor, we're going to dive right in here. And Tracy, I think you're hitting lead off today.
I am. Thank you, Bruce. I appreciate that opportunity for you to let me lead off here. Hopefully I can hit a good single right down the middle. So Minor, our first question: when a small emerging brand is looking to, raise money, what's kind of the mental checklist they need to go through before, approaching an investor? What do they really need to think about before they start talking to you?
Yeah, Tracy, it's a great question. And I think I think we can talk about this a little bit later, but there are various stages that companies are in when they're raising capital. It ranges from really early, where you're investing sweat equity, as no cash. There may be a little bit of cash, but it's a lot of time, energy, and effort, all the way to later stage businesses where you're investing your money, but also you're gathering money from other sources like institutional investors. And there's a whole broad range in between those two sort of extremes, right? So private equity on one side, debt maybe even further to the right, but then the earlier stage be sweat. And we can talk about that a little bit later. But I think when I tell companies sort of what they need to do, I think about the business plan, and I think about, okay, so, and I really encourage companies to do this, and I get a lot of pushback sometimes, but what is the business plan? So I think the business plan has to address, a variety of areas. And I'll just sort of like off the top of my head, just go through what those areas are. So typically it's like, what is the problem? How do you solve the problem? What are the unique attributes or competitive advantages that you've got? What is the moat? I think Warren Buffett is the guy that always talks about the moat around which you build your business, and how does it keep competitors out? What is the total addressable market of what you're trying to do? What's the vision for the future? I think one of the things that sometimes people they don't want to think, I mean, they want to think long-term. They want to think about the ideal scenario and where you're going to be, but they don't really carefully think out how you get there and what it's going to look like. But that helps in a variety of ways. That ends up being the story of sort of what you're weaving in your business planning and in your business plan that you will present to others outside of your company to raise capital. Who are the competitors? How do you go to market? Who is responsible for, who's the team that's going to lead this to where we're going to go in the future? Really important. I think a lot of companies just don't think about this, is that you need to have traction. So where are you in terms of traction? Excuse me. Where are you in terms of sales growth? Where are you in terms of profitability? And if you're early stage, you got to sort of prove out the concept, right? So that's traction in and of itself. Sometimes traction is just starting the company, but you want to demonstrate that you have momentum and are making headway. And then finally, you got to think about, so what do you want? Like, I mean, if you're planning long term, you can sort of think of the company in increments. Here's the short-term capital need here, according to my long-term plan. Here's the medium-term capital need, and here's the long-term capital need. And I think if you do that, you can see various valuation increments arise where you can sort of set valuations potentially. Excuse me. And that gives you a really good idea of sort of how much of the company you're going to want to give away from a equity perspective, but it also gives you a sense for the people you're going to surround yourself with, both investors and on your board of advisors. And that's a long response, but I hope that's okay. I mean,
no, that's great. And I think what you're saying is you really need a business plan, and how Bruce and I talk about that is a go-to-market. Part of that is a go-to-market strategy. You've got to have a roadmap. And so Minor, just share with our audience real quick that I thought of this is, what percentage of the people that you talk to, in an average week actually have a plan, have a business plan, have a strategic roadmap, have a vision of what they really need and where they want to go and how they're going to get there?
Yeah, I'm going to break that into two different areas. So we look at a lot of later stage type opportunities. So a lot of times it's in their first roadshow, so they typically are pretty well prepared. But it's, we also do some earlier stage things. And so when I look at earlier stage, I don't see as much preparation, honestly. And it impresses me when I do see preparation. So I think, if I could just give anybody any kind of advice raising capital, no matter the size of the business, I would just have that business plan ready to go. Think about it, and thinking about it and doing the work. I mean, part of being an entrepreneur is doing the work. Really think through the business plan and create the business plan. It makes you think about things that you would not otherwise think about. And look, if it's not your best, if it's something you're not really good at, get some help, seek help. I mean, you'll have friends and family members and others that can help you sort of think through that.
And Minor, just to build off this question a little bit, can you give the folks out there, if they're a smaller firm, let's say right now that they're 20 million or under in sales, what kind of, when we talk about the business plan and the granularity you might be looking for, is this a gruesome 80-page document, or can it be, as long as it's well done and clear, can it be something like 20 pages?
Yeah, I mean, I would honestly, when somebody's out raising money, I'd break it into three separate sections, really. One is you're going to have an overview, a complete overview of the business, 2 pages, brief. It hits the highlights. It tells people what traction you have currently. It typically looks at the sort of the total addressable market, the go-to-market strategy, and the management team, and sort of the partners. And you can get that in a couple of pages. That's to give people, it's totally non-confidential. you can give it to a lot of different people. You can use it as an overview of your business. The second piece is like a 15-page deck that is a general overview that doesn't include all the detail. And then I would have in your sort of back pocket a very detailed, a little bit more detailed business plan that goes into detail about total addressable market, go-to-market strategy. It maybe has a lot more detail on the operations side of the business and some of the long-term kind of aspects of the business. But I think when you break it up into those three things, it sort of hits those stages of the investment cycle that you have with a private equity or growth firm, where you literally have to first, get to a meeting or get to a conversation. That's the teaser. And then you get to a meeting where you have several of the partners there, and you use the 15-page deck, and they're going to ask you a ton of questions. But the 15-page deck is perfect for that. And then in the due diligence process, you'll use that other document, the longer-term business plan document. And I think in doing that, you'll be able to answer a lot of questions.
Yeah.
So Minor, following up on that, a lot of these smaller companies that, either outstrip their own cash, or they're risking their marriage by taking the second mortgage on their home. What types of levels of investments out there? I mean, we all know the words, but you know it better than we do. There's friends and family, there's angel there. Can you just kind of touch briefly on and let's not talk about the $100 million check, but what are those phases of the early steps on this ladder to raising money?
Good question.
Yeah, I think that's great. I mean, look, I'm a big believer. I think if you look at, and Bruce, I know you listen to a lot of podcasts, and if you, and I've had a lot of experience in sort of all these different stages, honestly, and I've really enjoyed every aspect of it. When it's early, I think it's going to be sweat equity, and I think everybody has to sort of have that sweat equity. Every entrepreneur has that sweat equity situation where you're working weekends, you're working nights, you may have a family and you may still be doing this, and entrepreneurs sometimes, they should have a balance, but they don't. But you're really getting the concept ready, you're proving out the concept. It's very early stage. The next level is really you go out to friends and family. You've gotten your concept, you've demonstrated a test that could work. In a consumer product, maybe you've gotten into a couple of different retail locations as a test, local. Then you say, look, I've gotten into these different retail locations. We've had sales traction. So you go to friends and family and say, this is what I plan to do. Is you got your 15-page deck, and they get interested and they invest. And then after that, when you need money to broaden out your retail presence, maybe on a more, a test of a regional level, you're going to angel investors, a little bit more professional. It's usually an angel investor network in larger cities. And you're actually going to be presenting to people your business plan. But you've tested it, you've gotten traction, you've gotten friends and family to back you. So these angel investors are individuals, or they can be firms that will invest a little bit more money. That could be, $1 to $2 million. I've seen them as large as $5 million, but $1 to $2 million. And then you go into the growth capital phase. And growth capital is where you have your concept, you've proven it out regionally, and you're ready to sort of go for it. And that could be anywhere from $5 to $10 million. If needed. I mean, you have to really analyze the need, but if you're going to retail, you're going to need a lot of money. That's growth capital. You may be negative, what I call cash flow, like you're still having to invest money into the business and your cash position is dwindling, but you're growing like by leaps and bounds, and growth capital puts money in there to supercharge that and get it to the next level. And then after that, it's, private equity and debt. One thing I want to say about debt, there's a lot of venture debt out there, and it can be useful at times, but and they're convertible notes, which are a lot of times used in angel investing. But if it's true debt, if it's debt where if you can't pay it back, they can take over your company, you've got to watch out for that. Yeah. You've got to watch out for that. I would never recommend that in an early stage business.
Hey, Minor, one follow-up question here before I give it back to Tracy. So, and the answer might be every case is unique. But as these entrepreneurs, they've done the sweat equity, they're gaining some traction, and they're either going to friends and family, or maybe they've crested that and they're starting to look at angel. Are there any rules of thumb as to how much of your company you give away early? Because, you know, in your zeal to raise money to keep growing and chasing the dream, you know, you'd hate to give away 80% of your company for the first $1 million. I'm just making that up. I don't know if you have any guidelines you can offer the group.
Yeah, it's a great question, Bruce. It's the biggest question people ask. I left one major piece out, and I just want to say, in between angel investors and growth capital, there's typically venture. So that's venture capital firms. There are lots of venture capital firms out there. Typically, after the angel round, you go to venture. You get to another level, then you can hit the growth capital markets. As you go along, you're raising more money, and you know, potentially you're diluting your position. But I want to tell people that a smaller percentage of a much larger pie can be much more meaningful than a large percentage of a company that's, you know, just sort of treading water. Okay, so you got to think through that. So that relates to your question, Bruce. There's just not really a real equation. I mean, I've seen a lot of, you know, sweat equity transactions where the pre-money valuation, they're pretty low sometimes, but the capital raise is not that large. So you don't give away a lot of equity. It's really a negotiated, like in the earlier stages with sweat and friends and family, the entrepreneur has more control over what the valuation is going to be. And sometimes you can do convertible notes that convert into equity that comes in later from angel investors. But as you get into the angel investor, venture, and growth capital pieces, it's really going to be a negotiation, and it's going to depend on where you are, the traction, total addressable market, the management team, and all those factors, and it's going to be negotiated. You know, I think when you get past venture and into growth capital, you know, you start looking at, I mean, I'm going to make a really broad claim here, but maybe you start looking at you've given away, you know, 30-40% of your business at that point, typically. And it's so important. I mean, look, don't use that as a benchmark. I mean, I think that's just on average. I haven't checked that, but that's just sort of my gut. It's so important to have partners, you know, at every stage, people that can help you out, add value, you know, help the business grow. Check you when you may have a strategy that may not work. I mean, you want feedback. And so, you know, when you're raising this capital, you need people that, you know, you need both people that will be passive and believe in you, but you also need people that can be there to like really help you out, like you guys.
Yeah.
Great. Tracy?
Awesome. Yeah. So our next question is, so when you're looking at a brand or somebody approaches you or any investor, what kinds of things are you really looking for? Is it about the brand? Is it about the product innovation? Is it about the founder? You know, give us the top 3 things that you really look for when somebody approaches you with a potential to invest.
Yeah. I mean, look, I think the management team is like really important. I'd put it first on my list. I mean, experienced management team, ideally somebody that's done it before, but it could be a great idea and a very unique idea and a defendable idea that could be awesome with a management team that's not as experienced, or a few members that are not experienced. But I want a team that's like aligned with us monetarily. I mean, because I think that means in our firm, it means that people are all rowing in the same direction. I mean, we're big on value add ourselves. And so if the management team is aligned monetarily, either by sweat or their own cash invested in the business and the option pool, that's sort of where we want to be. The team has to be logical. I mean, about the business, about future valuations. They got to be fair and reasonable. The team you got to be flexible. You got to be nimble, smart, intelligent, obviously. One of the most important things is open and you know, not arrogant, open to suggestions, open to partnership, open to other solutions other than their own, you know. So that the team is really important. Look, in most most investors don't think they know everything. Some of them do. But the team is always, an investor is an investor. A management team member is totally different. It's a partnership in my view, in our view, collectively here at Bourne. The second thing I look for is like the traction piece.
Yeah.
Sales growth, all that. The moat, the innovation, it's really important. And I think, look, in the consumer health and wellness piece, the products need to work,
Right.
I mean, so I like to see like
Seems
products.
kind of logical. Right.
Yeah, sorry, I interrupted you. I apologize, Tracy.
Go ahead.
Yeah.
Hey, Minor, so moving on, and you touched on this, but I want to ask you directly. So what counsel would you give a founder or a small company seeking money? Give them a little coaching on what they're looking for an investor. I mean, it's one thing to just get cash. You've mentioned value add. So what should a company that's going to give away literally a piece of their heart and soul and invite someone else to their table, what should they be looking for aside from just a check?
Yeah, I mean, look, I'd be looking for somebody that understands that it's your heart and soul that you're giving away, and they value that, and so that's like number one. Ethical, obviously, these are like order qualifiers. But it's really people that can help you in your business. It's you want to see traction, so it's somebody can help you, source customers. Maybe it's somebody in the regulatory or other area that can help you sort of run those channels as you build your product set and build out your products. Sales and marketing expertise. I mean, Bruce, and a lot of the stuff a lot of stuff we've worked on, what I've valued is your knowledge of the retail channel and Tracy's knowledge of the retail channel, how to go to market, how the retailers operate. Those things are like invaluable. So the value add is really important. And, I think in various areas, it's very, you look at your business areas and where you have weaknesses, it's great to put somebody in a advisory board position or a true board position, in a capital position that can really help you in a lot of those areers. Excellent. They may have connections to raise additional cash too, additional capital, and that's very important as well.
Thanks. The next question I was going to ask, I think you've touched on it a lot, but I just want to give you a chance in case anything else has come to mind. When the entrepreneur or small company is out looking for the money, what kind of information would they need to be prepared to give? And you talked about traction, you talked about kind of IP and their moat. Is there, if we've already really covered it, Minor, we can move on. But if there's anything else because sometimes entrepreneurs, they love their idea, they guard it very closely. But if you're asking people to invest with you, there has to be, to your point about trust and being open to ideas, you got to be willing to play with some of your cards up on the table, right? So I don't know if there's anything else you'd add that an entrepreneur needs to be prepared to share in some level of detail.
Yeah, I mean, I think there's a lot of background stuff, Bruce, that I haven't talked about. Like, I think you need the regulatory piece, you got to be like squared away on, right? Nobody's going to take regulatory risk that's, significant risk there. You've got to mitigate that. I think you need to have sort of a legal counsel and a setup in your company, and be prepared to raise the capital, because there are rules and regulations you have to comply with in raising capital. So these are all background things that I think you just got to sort of be squared away on. One of the things I'd really suggest that an entrepreneur do is really think about the challenges and risks in the business. And this isn't the most fun thing to do, but you got to think about, I've never seen a business like, everybody always thinks in some of our deals that have been really great and we've had a significant return on capital, they think it's always something that just goes, I'm not sure which that's going to show up on the camera, but always up and to the right as far as valuation and trajectory and everything. That's rarely the case. I mean, you're always going to have issues, and maybe sometimes very critical issues, where your growth is up and it goes down, and you sort of have an emergency and then you go back up again. you got to think about what's going to impact your business and how you're going to react, because it's not going to work out according to the business plan you presented. I mean, it's just not. And you need an investor that understands that as well. So an understanding of the risks and the mitigants and the flexibility piece is just critical.
Hey, Minor, one other thing. We talked briefly at another point about just making sure that the ownership of the business is clear. Like there's not a mystery former partner where the legal it's sadly in this day and age, divorce, does an ex-wife still or ex-husband own 10%?
Yeah. Yeah. I mean, look, any institutional investor is going to do a complete background check, and they're going to do a lot of diligence. You got to be willing to like open the kimono up to people. So you're exactly right, Bruce. And I should have brought it up, but I mean, you've got to have title to what the idea. You've got to make sure that you own it clearly and outright. You don't want any kind of like question about that. A product, a company. A lot of times, spouses get de facto ownership of a business, and you just got to figure that stuff out before you go to raise the capital. And so those things are really important, along with regulatory pieces and things of that nature.
Thank you. Tracy?
Yeah, so here's the Grim Reaper part, as Bruce calls it.
Oh, no.
Talk to us about some of the biggest mistakes you've seen, brands make when they come to you. What are the top 3 things that you would tell a small emerging brand to avoid or not to do in the raising of the money process?
Yes, it's maybe a little bit longer than top 3, Tracy, if you don't mind, because I think
Not at all.
just a lot.
I think our audience needs to hear it, but go ahead.
Okay, so one of the things that just really I've seen just work in the wrong. I'm going to be really quick about this. Entrepreneurial arrogance and lack of nimbleness and flexibility. There's no room for that. I mean, number one, I'm not going to invest with anybody that's going to be a pain to deal with. I think most investors feel that way. But if you believe the money offered by the investor is like more important than the fit of the investor relationship wise, don't ever make that mistake. It's not worth it. You don't want to get in a situation where you're constantly battling an investor just because you want to get the money in house.
Right.
Borrowing money before it's time to borrow. I mentioned that earlier. Not a good idea. Not being transparent, being not being timely on negative news, not asking for help from your partners and your board. These are all really big issues. Not being honest about risk and challenges. I mean, if you don't know the answer to a question in a meeting, just say, look, I don't know the answer. It's a great question. Instead of giving you an answer that is sort of half baked, I'm going to go back and research it and get back to you, and then get back to them quickly, after you think about it. Thinking you can do everything yourself. I mean, I think a team always wins. Do not go out with a ridiculous valuation. And along with that, I mean, it's just not going to work. If you go too high, and a lot of investors just won't even think about it because they think you're sort of unreasonable. Don't get defensive with questions that you may be asked. Understand that that's going to help the business. One thing really important is that there is a momentum in a transaction that takes place. If you lose, and Bruce and I have seen it, I've done it before, and I've lost momentum in a transaction. If the transaction momentum starts deteriorating, you're gonna lose the deal. And I think that's in any kind of deal, right? I mean, so keep the momentum going in a transaction. Don't delay and play games. Just, action is really important. And then I think understand that investors want entrepreneurs aligned with them. If you win, if they win, you win, and vice versa. I don't know, Bruce, what do you guys think? Are there any others maybe that I left out?
Let me chime in here because Bruce and I work with a lot of, small emerging brands. And I think what we see a lot of is what we call the my baby's beautiful syndrome. So this is my baby. I birthed it. I
Yeah.
think it's beautiful, and I think everybody else is going to think it's beautiful too. Even if they don't have anything to substantiate that, it's because it was their idea. And so we've seen a lot of arrogant, co-founders that think they do know it all and don't ask, and don't ask for help. And I love also your point, which Chris Hunter talked about when we interviewed him, the co-founder of Koya. He said they had a business plan, and in the first month that went out the door, the projections were all wrong, and they had to pivot because the assumptions they made were not right, or the market was different than what they thought. So I love your talk about flexibility, and that's really important. But you've got to be able to, ask for help and have that. What I heard you say is you've got to have a good team around you. It just can't
Yes.
be, just me.
Hey, Minor, a quick audible here. I've been keeping track of some of our discussion points here, and a couple of times you've mentioned valuation, which is obviously key, especially as a business grows. But early, when people are looking for their initial money, what are some reasonable proxies or equations that someone could use to justify their valuation? Because to Tracy's point, if I invent a great tasting, we'll stay with our joke, Tracy, gluten-free chocolate chip cookie, and I'm selling $400,000 of it, I can't put a valuation on that anyone will not throw me out of $25 million. Are there any like ballparks, like 4 times sales, at least no one will laugh you out of the building? Is there anything that you could provide some early guidance?
Yeah, Bruce, if you're generating like 400 grand on a gluten-free cookie and you got it's a great differentiated thing, at that point, it's really how much are you willing to give away? And I would not give away a whole lot in the beginning because it's hard to get back over time, right? And so in that scenario, typically you've got to come to a conclusion or negotiation with your investors. And I honestly, like if you're generating revenue, to me, it's like $7 to $10 million pre-money, depending on how much money you want to raise. And does that relate to the 400,000? Well, that's a ridiculous multiple of sales, but you got to make room for the entrepreneur to make money down the road, right? So if it's $7 to $8 million and you're raising $1 million, that's a lot of money for that size business. And you should be able to use that money to grow it exponentially at that stage from a trajectory standpoint and attraction standpoint. So, there's no real, when you're that small, that early, there's no real number that's going to help. And I'll take you back to the early 2000s. What was going on there is totally artificial valuations. Entrepreneur comes up with an idea. It's a huge idea. It's a frothy market. Somebody wants to invest 50 million, which is dumb because you don't need that much money. So you have to come up with a valuation that the entrepreneur will accept. Well, the valuation is, 300 million. Well, with no revenue. So there are market conditions that affect that too, So I don't know. That's what happened in the internet bubble quite a few times. And I've experienced that in the venture stage. So I don't know if I really answered your question, Bruce, but when it's small, it's sort of tough,
Right, but it gets back to what you've been saying, being open-minded, being transparent, finding someone that's at least mentally aligned with you that you can talk to and negotiate. And I also assume that one of the things which is powerful in any negotiation on either side of the table is the willingness to walk away.
Yeah.
So one other definition.
One more thing though.
Yeah.
So there is a tool, and I'm not a big fan of these tools, but I think they're useful. There is a tool you can use where you're going to raise more money six months out, and you do a convertible note. And it's really debt. You don't allow the debt holder to take over the business, but it converts into the next round of financing at a discount. And that's a good way to like preserve some equity, but then allow a more sophisticated investor come in and establish the valuation, and then that amount gets folded into that new round at a discount, which gives the early investor a premium to the valuation going in. So that's a pretty good tool that you
Hey,
can.
Minor, one other definition I'd like to just make sure we put out there for the folks. A couple of times you've used the phrase pre-money in what
Yeah.
we've talked about here. Can you just tell people what that means?
Yeah, pre-money is the valuation of the business before the money is put in. So in other words, if you're raising $1 million and you have a pre-money of, essentially 9 million, 9 million would be the pre-money, the million added to it would make post-money 10 million. And so that 1 million would own that percentage of the 10 million. Does that make sense?
Yeah, it just gives a little bit of color there.
Yeah,
So,
and I want to say one thing also. Entrepreneurs for their management team should set up a option pool because institutional investors are going to require it, and you want to incent your team. So I would set up a management option pool. You can talk to your legal counsel about how to do that, but that's a way to incent the management team for success.
okay, so we're getting toward the end here, Minor. So one question, let's say that someone has checked all these boxes we've discussed and they're ready to try to go raise money, but really don't know where to start. They've got all their documents, they're willing to talk. How does someone get a meeting? And where do you even start? Is it an introduction? Is it bombing people with emails? What?
That's a great question. I think it's best to have personal introductions to angel investors. I mean, obviously you got friends and family. Just ask your contacts and relationships who might have an interest in investing in your business. Then ask those people who might have an interest in investing in the business. Even if you get turned down, get something out of the meeting or the conversation. I would go and network in different conferences. There are tons of different sort of angel conferences, and there'll be local conferences. And I would get out there and network as much as you possibly can. A personal referral is always better than a blind email. I get tons of blind emails. I do try to read them all, but having people look at thousands of deals a year. I mean, some people say it's 500, some people say it's 200, but it can be a huge number. And contrary to popular belief, investors are busy. They're really busy. So that's what I meant about transaction momentum is important. The email with a teaser, a lot of times just doesn't work. So get a personal recommendation, work on your networking, work LinkedIn, and make phone calls. I mean, that's what I would recommend.
That's awesome.
Thanks. Tracy?
Yep. So I think, Bruce, we're ready for the big finish here. So Minor, unless you
hang on one second, Tracy. Minor, thank you so much for your time. Trace, sorry. Folks, this is live TV. It's unrehearsed. It's one take, baby. Minor, if people want to get in touch with you, what is the best way for them to do that?
Yeah, I'm on LinkedIn. So just hit me up on LinkedIn. Minor Hinson, Born Partner Strategic Capital. I live in Charlotte. So I check it quite often and would love to interact.
Great. Thank you so much for your time. Okay, TP, the big finish, baby.
Don't you just love live TV? Anyway, thank you, Minor, for being on. I think it was so helpful. I mean, a lot of the brands that Bruce and I talked to, 90% of them are looking to raise money, obviously. So I hope that our audience today found this really helpful, and we really appreciate your time. So again, the big finish, follow us on our LinkedIn page, Road to Retail, or our YouTube channel, Road to Retail. And thanks for joining us today, and look for future episodes. We've got some great more interviews coming up in our future. Thanks.
Good
Thanks
luck
for
out
having me
there.
on, guys. Thanks for having me on, and you guys do a great job, and really appreciate all the help you are giving to all those earlier stage companies. So appreciate it.
No problem.
Thank you.